Hey, Victor, another Federal Reserve meeting in the books a couple weeks ago now. What are we talking about with that, and what are our main concerns coming out of that?
Yeah, really interesting how that Fed meeting fell. Of course, we saw the Fed continue to hold rates steady, which is not what a lot of market participants, including ourselves, really wanted to see from that meeting. And that's what we're really talking about today is where the Fed is in the cycle, what their mission is, and why we really fundamentally think they are unfortunately behind the ball again. So to kind of create some background, obviously we saw back in 2022, the Fed early into 2022, the Fed had not started hiking rates. They were still buying bonds, pushing money into the system coming out of COVID because they're generating all that stimulus out of the COVID period, trying to get the economy back on its feet. Well, pumping all of that money into the system, we found out between the federal government, but especially the Fed, increasing its balance sheet by about $7 trillion, showed that whenever you put this much money in the system, you're going to create inflation. And that's what we've really been talking about for the last couple of years is the inflation fight, the inflation battle. And the beautiful thing is it looks like we finally have gotten to the point where the Fed is satisfied with that inflation fight. But the thing is, when we're talking today about the Fed being behind the ball again, it's very reminiscent to back in 2022 when the Fed was still buying bonds, still putting money in the system, still had not increased interest rates yet, but inflation was at 5%. And you would typically say, well, was the economy still recovering? Why did they need to keep putting money in the system? Well, they didn't really, because you had unemployment was below 4%. The markets were absolutely ripping in 2020 and 2021 because of all that cash that was entering the system. And they just continue to wait saying, hey, inflation is transitory. And we didn't get to a point where they were fighting the inflation fight until way too long. And so they're behind the ball then. And as we're going to continue talking about, looks like they may be behind the ball again.
Yeah, and so a big issue coming out of that inflation is transitory period where Jerome Powell was waiting to be reappointed, not related at all. But so coming out of that, they were, trying to make active decisions. They were trying to, as some of the best economists in the world, make a decision and look at the data and use that to just guide them in their decision making as a component of it. It's a lot of feel, what does it look like? Oh, we think it's this. And because that got them so behind the first time, they've really made that shift to being data dependent. Like you'll hear Jerome Powell say at least 15 times every presser is they're data dependent, waiting for the data. But now that creates a reverse problem, kind of like you mentioned, is that on the way down, well, all of these are lagging indicators. These are lagging numbers, previous month, previous quarter, inflation, unemployment, all of that stuff. So by the time they actually see it in the numbers and the numbers flip, which they really have, we're really at that point that they should be coming back in. It's going to be a month too late, a quarter too late. And then add another Fed meeting, which is another 6 weeks on top of that. And they're really getting behind here by several months. And then on top of that, one other thing I kind of want to add in there is that by making no decision to move rates at this latest FOMC meeting, that's as much of a decision as to lower rates or raise rates. I don't think anyone would come in here if there is no federal funds rate and say, hey, 5.25% to 5.5% that's the right policy rate for the 2.6% inflation that we have right now. And so that's effectively what the Fed is still doing by keeping rates high here. And so I think that's really just delaying the cutting process, which, we'll get into more as we talk about this, but a process that should probably start sooner rather than later.
Yeah, and on the inflation point, I mean, you're talking, we just saw that on a 3-month annualized basis, inflation's at 2.4%. The Fed's target's 2. And so to your point, the Fed funds rate was the same when we had 6% inflation, and it should be the same when we're at 2.6. I think most people would disagree with that. And I think that's what the market has become concerned with as of late is the trend especially in the labor market. And so that is the biggest concern. If you're looking at economic growth, if you're looking at the future potential of earnings for many of these corporations, if you're looking at just the general health of the US consumer, jobs are going to be much more important than some relatively arbitrary inflation level. If you're sub 3% on inflation, that's going to hurt somebody a lot less than if they lose their job. And so that's where the market is saying, hey, Fed, you really should have cut at that end of July meeting, because we need to get back on track to where you're enabling companies to maintain their employment or increase employment so that we keep this like really nice labor market that we've been able to generate thus far. And I do want to clarify that our concern is not that we are in a bad place with the labor market right now, but it is more so the trend. So we've seen a little bit of softening, more unemployment, a little bit less of job growth, and the levels themselves aren't something to be shocked by or really be too concerned by, but it is the trend downward that everybody is watching right now. And what we want is the Fed to act in a way that's going to help propel that labor market so you can maintain these levels that normally, say in a pre-COVID period, would have been reasonably good. It's just because of the trend and where we've been moving that it's really creating concern for overall market.
And yeah, like you mentioned, we're still at good levels with unemployment, but as you probably heard a lot about in the commentary and news lately, we've breached the SOM rule that people have started quoting a lot, and that's essentially just tracks the rate of change, the rate and uptick in unemployment. And so over a period of time, we've accelerated back up to, we're now just above, that 4% level. That's really, it's not a bad place to be. That's about, kind of where you want it, around 4%. But the pace at which we've gotten there from the vastly, tight labor market is what's concerning people, is that that's moving so fast. Those things don't just turn on a dime. It's not going to go from, rapidly rising unemployment 1 month to, okay, we're fine again the next. So that's what's really concerning people, is just the rate at which that's moving. And, in order to instill some more confidence in the small businesses that drive a lot of this, and even large businesses too are affected by it, getting a rate cut or two in would really do a lot to instill that confidence in businesses.
Yeah, definitely. And I think as long as we're trending in that somewhere 4 to maybe 5% unemployment range, that's typically, very standard unemployment just because of the natural turnover for people in their jobs. You're not talking about mass layoffs. You're also not talking about an environment where nobody can get a job because the demand, or nobody can hire is really what I should be saying, is that nobody can hire because everybody is in their job already. So you're finding kind of that sweet spot in unemployment right now. And so that's why I want to reiterate, it's not really the level that we're concerned with, it's just the trend. And even Claudia Sahm talking about her own rule. I mean, she's a famous economist. Obviously that rule is tokened from her, but she even kind of made a clarifying point, is that this may not be a recession indicator just because of how low unemployment was coming up to this point. So that trend is not necessarily indicative of something that would cause recession. Now, if you're talking about going from 5.5% to say 6% unemployment, then that triggering of the SOM rule would certainly show a more likelihood of recession. But what we're kind of getting back to is the Fed needs to create this environment that creates some stability for the market in order to make sure that we maintain this range of employment.
Yeah. And great point on the SOM rule. But as with economics, people love their rules. People love their recession indicators. Oh, it flipped. Hey, the yield curve's been inverted for how long now? A couple of years. And we're still waiting on that recession. But, it's as with any overly complicated thing like economics, which there are just so many moving pieces, people love to hone in on those rules. But, I want to kind of put this in perspective of why we're spending so much time talking about the labor market, is kind of what we mentioned earlier, is that the inflation fight is pretty much over. 2.4% 3-month annualized inflation, 2.6% core PCE. That's not not a bad place to be. And it's kind of back to the perfection is the enemy of the good. Of we don't need to get back to 2% to be good. Let's keep the inflation good, not strive for perfect and end up crushing jobs, crushing businesses because of it.
Right. And that goes back to some of the conversation we've had before of the Fed balancing this labor market and inflation battle, and why we don't want to see them behind the ball, because two things can result by that if they don't cut soon enough or cut aggressively enough. Is that one, you could have the labor market go into disarray where you have unemployment continue to rise. And two, you could have inflation actually undershoot that 2% target. And without any inflation in the market, of course, we had a whole episode dedicated to the pros and cons of inflation, but it is good. Going back to that episode, talking about there having some inflation in the market is definitely a positive. And so if the Fed doesn't cut soon enough and doesn't cut aggressively enough, then we may get to a point where you're hurting the labor market and you're not generating enough inflation for the market. And so that would actually create some problems that we're not seeing right now. And so I think the Fed needs to be conscious about this. And I guess going from there, obviously we didn't see a cut in the July meeting. All signs are pointing to a cut, potentially two cuts now, because it's looking more and more like the Fed is behind the ball at the September meeting. What is your kind of thought process? What have we been talking about as far as kind of Fed action from here moving forward?
Yeah, I don't think anyone's expecting them to come out and do an emergency cut, which they have done in the past. They can do. They don't have to wait to an FOMC meeting to cut interest rates. And I think that could spook markets if they did that. I think that it's also easy for them to qualify that away and just tell people that, hey, we didn't have this data before, we have it now, and we want to move sooner rather than later, which may actually just be very much appreciated from the markets who have been kind of worried about this for a long time. And we've even heard the Fed talk about it in the past of they don't want to get behind the ball again. They want to start the easing process early because it's a long process. They want to take it slow. They don't want to do two cuts at once. Jerome Powell was asked if there's any chance of a 50 bip cut in September. He didn't say there was no chance, as he'll never say something like that. He'll never take the option off the table, but he said that wasn't currently, in the playbook, that wasn't being discussed. And so to go from that stance one meeting to a 50 basis point cut the next is not what the Fed wants to be doing. And, like we've been arguing, let's, cut now and then just take it slow. But it's looking like that might not be an option anymore.
Yeah, and I think all of this goes back to the data dependency factor. And this is where I see the risk in the market right now is not these single day swings in the stock market where people are reacting to one job print or one labor print or some kind of piece of economic data that is going to warrant some huge transformation in the market. The day-to-day is something that I think most investors should really look past, and the single data points as well is something that investors should, take with a grain of salt. I mean, especially if you go looking at the prior jobs data, there have been huge revisions in jobs data most of this year and last year. So it hasn't been the most trustworthy source of information to begin with. But going to the data dependency factor, and what I see as a concern is that, say we get through this volatile period that we're in right now, and data looks pretty good, but then all of a sudden leading into that September meeting, maybe inflation ticks up a little bit, or maybe the job market gets tight again and unemployment drops, and then the Fed says, hey, maybe we don't have to cut. Well, I think that's where you have the issue, because all of these data points, to your point from earlier, are backward looking. And one data point is not going to identify a broader trend. These are going to fluctuate. You may take 2 steps forward, 1 step back. But what I really don't want to see personally is maybe some hotter data or better economic data than expected. And it keeps the Fed from cutting in September when that's really what they should be doing.
Yeah, they should get started, like we've been saying. They should get started early and bring that down, like that interest rate down a little bit, because again, no one's going to look at 2.6% annual inflation and go say, hey, 5.25 to 5.5% is the right number. So let's get started sooner rather than later and just progress from there, taking our time with that. I think one thing that we've seen a lot in the markets, to your point of the day-to-day swings, is there's a lot of recency bias going on. As we like to talk about it more formally, of a new number comes out and then all of a sudden that's what everyone's fixated on. Like, to your point, let's take things in context and perspective, and not get too worried one way or the other about any one data point. One thing I think is going to be really interesting to see is at the September meeting, they'll have a new dot plot where you see the Fed governor's expectations for future interest rates. And so assuming we get one cut there, we'll be able to see what they project for the end of the year, which will really show us what we're looking at for the November, December meetings, and potentially 2 more cuts, 3 more cuts this year, So I think that's one really important thing to look out for.
Yeah, it would have been ideal if the dot plot had come this prior meeting, just because then the market would have some kind of foresight into the Fed thought process. Of course, the last time we got the SEP, summary of economic projections, or dot plot, it showed 2 cuts for the year. It was kind of the median expectation by Fed governors and presidents. And I expect that to tick up. I think we pretty much all do at this point, given the softening in the data, but certainly going to be something to watch. I think going back to your point about focusing on the most recent data is kind of just this broader trend in what I think our society looks at these days. The news cycle seems to be so fast. I mean, you have an event happen a week ago and people have already forgotten about it. And I think the same is true in investing, and a lot of market participants, especially with the proliferation of options and a lot of more frequent trading, has kind of led to this much faster news cycle and these more volatile swings. I think it's really interesting for us to navigate as professional investors, where you can't just focus on a single data point or a daily move in the S&P. You really have to look to the long term consistently. And I think as long as you're focusing on those long-term fundamentals, as we're talking about the Fed and their actions over the next 6, 12, 18 months, that's what you have to be focusing on, not necessarily what's happening on a week-by-week basis. And I think that's just a broader trend. That's something really interesting in the market, but something that you and I really pay attention to and really look through, rather, in order to kind of inform our investment decision making.
Yeah, exactly. And to that point, the market's been Fed driven for a long time now, and there's still a lot of good earnings, good companies. So taking a little micro look, but at the same time, very much a long-term perspective on it, are really 2 really important things to do in this kind of market environment.
Yeah, well, I think we covered the topic well. Hopefully Jerome Powell and the rest of the FOMC are going to listen to this podcast. Maybe they'll get some insights and help them with their decision making. But, only time will tell what the Fed does and whether they are or are not behind the ball here.
Yeah, exactly. Thanks, Victor.